Welcome to the Adventures in CRE audio series. Join Michael Belasco and Spencer Burton as they pull back the curtain on everything commercial real estate and introduce you to some of the top minds in the industry. If you want to take your skills to the next level and be part of a growing community of CRE professionals across the world, this is for you.
All right, hello and welcome back to the podcast. It's season 3, and we continue on in the vein of deal making and deal doing. I got Michael Belasco and Spencer Burton with me here in studio.
I like the way you said my last name.
It was maybe with a little bit of an accent, fancy, maybe, I don't know. Anyway, so today, we've talked about strategy, sourcing. Today, we pick up on this theme, this season 3's theme of capital raising. Right? If you're going to put deals together, you're going to need money to do it. And there's a couple different ways that folks go about that. So let's get started into that. But if you're listening to this podcast, or this is your first episode or whatever the case may be, you've just tuned in, it should be of note that season 3 so far, I have to say, is a lot of fun. And what we've done so far is we've started out at the very beginning, and we're talking about deal making and deal doing. And what we're trying to do is we're trying to give almost a storyline about how these two things work together, and how if you're a real estate professional, a commercial real estate enthusiast, some of the things, the case studies that you guys have been involved in to really expose some of the nuances of getting this done. And capital raising is a huge part of this. I think it's daunting for a lot of people. So Spencer, we'll turn over to you. We'll talk about the general framework of how it's generally done, and then jump into some cool stuff.
Yeah. We talked about in the previous episode sourcing, and that's ultimately bringing in investment opportunities, right? And once you have an investment secured, in order to close that investment, you need capital, right? When we say capital, we're talking equity, and we're talking debt. Sometimes you have some creative also slivers within your capital stack. Michael might mention a few of those in a minute, but and I generally throw this capital raising piece into the deal making component of our framework, deal making versus deal doing, even though there's certainly doing in the capital side. And so capital raising, we're going to talk about kind of the keys to it as we see it. The first being, not a surprise, but I think the most important element of raising capital is relationships.
Here we go again.
Right? This was number one in sourcing. You can't say this enough. In fact, right? So we're scheduling our, we have out our networking reboot cruise.
Right.
It's all about kind of relationship building, and you build relationships, you build like trust with individuals through shared experiences.
Uh-huh.
And I know this sounds like a plug for the networking reboot cruise, but relationships are so incredibly important both to the sourcing and now to the capital raising that I think it's worth bringing up. And those relationships, in my experience, are best built through shared experiences. And whether that's doing deals together or whether that's going and vacationing together. Yep.
Yeah, and it's funny because it seems like we're plugging this thing, and we're definitely not. It's just every time we sit down, we're like, okay, the next episode is going to be about capital raising. We go through and we start talking about what really gets this done, what really moves the needle. And in every step of this process so far, the undertone of your relationships and your network has been there. And has not only been there, has been a big participant in getting the result that you want. So I don't think that we're necessarily plugging it. I just think that there's no way around it. Like, that is what gets the job done.
You know what? There are ways to slog through processes and get it done, and there's ways to do it, and you could do it. It's not like relationships are impossible. But Spencer and I have seen firsthand in specifically capital raising the benefit of having a good reputation and strong relation. Good reputation. B, those strong relationships. Greasing the skids is like the understatement of the year. It is like, you're going to take a year, you're going to take 6 months. Well, a relationship in this world, in capital raising, could expedite that by 10x.
There it is again.
legitimately, and
Yeah.
this is not hyperbole. This is absolute truth. It's absolute reality. You can raise capital. You can go find a broker. You can go find somebody to help you do that. But having relationships makes this thing. And that's very high level. We'll get into the details, but
Yeah.
I wanted to emphasize it.
So you had two different ways of looking at raising capital. Is that right?
Well, look, I have a list of things that I think are important to raising capital. The first is relationships. I bring this up. I mean, the great example of this is Heinz. Let me use Heinz as a perfect example, right? Michael spent some time there. When Heinz needs capital for a project, there's a line of LPs, mile long, lining up to invest capital into that project, right? That's a relationship. Now, it may not be a personal one-on-one relationship, but it is relationship of the people at those firms and the relationship at that line of LPs that are coming out the door. And what that means is certain people have an advantage in this space simply because
Reputation.
they put in the time and the reputation. Yeah, and reputation. We talked in the last episode. It's trust building. That's really what that reputation. Because you could have a bad reputation and you're not raising any capital, right? And so it's having trust with the market. And we could give a great example of this at Stablewood, but we won't. But just needless to say, Glenn Lowenstein, who was our CEO, has just an impeccable reputation within the industry and great relationships, and that made capital raising a much easier task than it otherwise would have. Now, the flip side of that, and this is actually the second point, if you want to make it easy to raise capital, have a proven track record of success, a long resume, and that actually, to the Heinz point, that's part of it, right? Is they've been doing this for a very long time and have this great track record. You look at the greatest capital raiser of all time in real estate, Blackstone. Like, no one raises capital like Blackstone does. And why? Because they've got this proven track record. And so big equity providers know if they put their money with Blackstone that it's a safe place, or at least presumably, right? That's the implication, and that's because of that track record. Now, the flip side of that, and this is now to my first real example, and I'll leave names and specifics out for this individual and firm's experience, but I think that the story will still hold. So there was a kind of a newer individual to real estate. This individual had done a few smaller deals, but largely was new to real estate and had raised capital up until that point through friends and family. And this individual decided to go and do an entirely different strategy, a strategy which this individual had no track record whatsoever in. But this individual had some relationships. And this individual was very persistent. And this individual had a compelling investment. And in the end, was able to raise the capital through a syndication. When we say syndication, it means through a whole group of investors. Was able to raise capital for this first investment. And this individual, by the way, is not any of us, the three of us, but someone that is an incredible person. And I wish we could use their name, but just because we don't have permission to, we shouldn't. Was able to raise capital for that first, and it was a lot of work. They had to do webinars, and they had email campaigns, and they were doing social media campaigns, and they were out there, and that, again, a compelling investment that if this was a Heinz, they would have had capital maybe before the deal was done, right? But it had to go through all this work because they didn't have the track record and their relationships were somewhat shallow. Now that this individual had their first deal done, they just came to market with their second deal, and within 24 hours, had the deal done. They had a track record. And it was only a track record of one. That's all it needed. Track record of one, raise all the capital in 24 hours. And by the way, when I saw that come through, it made me feel so good because I'd been like cheerleading this individual on. I was like, when that first go around, it took them months and months to raise the capital they needed. The second go around, 24 hours.
I want to ask a hypothetical in this.
Yeah.
And just use that example for your response here. So let's say it seems to me like that's an amazing feat. Okay. They did all that themselves. And as a result, the next time everything was way easier. Okay. So that's good. Last episode, we talked about partnering up with people who already have that type of experience. I wonder, and this is where I want your guys' feedback, in this particular situation, if somebody was thinking, well, I don't want to do webinars, I don't want to do email, all that, would this be a situation where going out and finding a person with a track record might be the way to go?
Yeah, I can answer this well. First off, yes, absolutely. And there are times that this happens all the time. I mean, it's very common to have co-GPs, right? And why is that? There might be a GP who's not proven yet, or it's just a space that they've just never been in. And they can't raise the capital themselves on the GP side, so they might need that capital and they might need that support or that leverage. And so, I have an example of and that's actually a great lead-in question of a deal that I actually worked on that came through, large institution, small partner ended up tying up a piece of land way bigger, pretty much way bigger than they could chew off, right? So they had relationships with with a large institutional partner. Showed up, pitched them the deal, said we need GP support. 99% GP support, so of a massive deal, something that they were able to tie down. They did have a bit of a reputation in the market in this example, but they didn't have the capabilities to source the capital. So they showed up to the juggernaut. There was a track record there. They got brought on. A deal that they could have never taken down ended up being over $1 billion project.
Whoa.
And here's what's the crazy thing. So they went out and got the GP. The GP brought on an LP. So this was a bidding process with the city, right? The city owned a couple pieces of land. They ended up getting it under control, and there was a negotiation going on. Now, the LP came in, and this is sort of the power of this. The LP had a loan on a property down the street. It was like one of the last developable pieces of land for a high-rise. And now the LP shows up and says, oh, by the way, there's this piece of land that the city at some point is going to have to get rid of. They tied that piece into the deal. So it turned in this deal that became a $1 billion project, ended up becoming close to $2 billion, simply because reaching up to a co-GP who had sufficient contacts in the market was able to help raise this or springboard it into the next level, something that this GP could never have done on their own. So
that's the third door, sounds to me.
Yeah.
Yeah.
So
I tell you what, so it's interesting because we talk about relationships, keeps coming back to relationships, but it also comes back to like everybody has different strengths and weaknesses. Okay. And so picking a partner that would have the mental dexterity to think about, well, what if we did this? My brain doesn't necessarily work that, like, I don't always see all the pieces that way. I can come up with ideas and I'm pretty good. But I need to be able to, and that's almost like a negotiation skill. Would you call that a negotiation skill, I think?
the creativity piece?
Yeah, just being able to say, hey, there's all of these parts on the board, and I think if I move this one and that one, then I'm going to be able to take the king or the queen, whatever. Is it the queen you take? I don't know. I don't play chess.
You ultimately want the king.
Okay,
yeah,
so
the queen is the most powerful.
Yeah. In this case, I mean, that's a pretty ingenious move.
Yeah, I mean, you think of it, there's so many different ways. Like if you are, look, if you're looking to take down a piece of land, there's an opportunity to go to the seller and say, or somebody who's not a seller originally, and say, hey, I have this idea, I have the experience. You might not be forthright in that you don't have the capital, but say, hey, do you want to be involved with this? You contribute, right? Contribute your land. You get involved in this deal. That's raising capital. You may do something like that, and maybe your intention, maybe this is a phased idea. I'm just thinking like creatively, and I've seen these things play out where it's like, I want to do a high-rise development. I actually don't have the capital for that, but what I do have is the ability to bring people in who can contribute, even if it's not, like if you need people to design and develop, right? Maybe you don't even have the capital for that. Maybe you're starting that. You get people involved, you pitch them an idea, contribute your land, contribute this. Going through an entitlement process, as we talked about, I think, on a previous episode, land is worth X when it's unentitled. In certain places, entitlement is like the biggest value add you could possibly do to that piece of land. And so you get a team on board, and this is capital, in a weird way, it's capital raising.
Yeah.
You get a team on board. Hey, look, we're all at risk here. But on the opposite, let's say a piece of land's worth $1 million unentitled, right? And this is, okay, we'll say a land is worth $1 million. If, hey, this team, hey, contribute your land, architects come on board, entitlement guy, whatever, here's a sliver. This is worth nothing. It's high risk right now. If we get this to the end, all of a sudden this piece of land could be worth $10, $15 million, for example, right? Now, all of a sudden, everybody in this deal now has $10, $15 million, or at least a sliver of that. And then you need to go out and raise capital. Skin in the game is another big piece to capital. What's your skin in the game? Well, actually, now we have $15 million in the deal. And by the way, we're the ones that raise it. Now you can structure capital thereafter so many different ways. So, I mean, it's endless. The third, the fourth, the fifth door. I don't know what kind of door we want to go through here, but there's so many ways that you can get creative and just, it's not, we've gone off on a tangent because we're really talking about capital raising and what's the straight and narrow, but there's all kinds of ways to do it.
So do people struggle with capital raising simply because they just think of it as a very vanilla, straightforward process, like go to the front door? Again, we keep coming back to this third door, but they go and get in line like everybody else?
Well,
okay.
So relationship and track record really are the two things that drive. That's the front door.
Yes.
You have relationships and you have a track record.
That's the front of the line on the front door.
That's the front of the line on the front door. That's a good point.
That's very a good place to be.
Yeah, yeah. There's a bouncer at that door, and he or she's kicking people out of the line constantly.
Right.
And you move quickly up and right through the door. But the third door is what Michael's saying: be creative. Right. There are creative ways. If you're newer into this and you're looking to raise capital, there are creative ways to raise capital. Whether it's bringing on a co-GP that'll help make that happen, whether that's finding tax advantage financing that exists out there, whether that's bringing in the landowner as a partner. I mean, there's a whole variety of ways that you can do that. Again, it's to get the first deal done so that you can then use the front door.
Yes.
You have the relationships, you have the track record, and it becomes much easier from that point forward.
And it seems to me like all of this kind of I love season 3 because we're going through in this very chronological fashion. So to me, raising money is almost, if without the relationships, we'll say it that way, it becomes a challenge when our strategy isn't sound, when we're not sourcing deals that are instantly attractive to capital, right? But if we do those 2 steps right, then that can position us towards the front of the line, even if we don't have the track record. But again, now we're talking about things that we can do to, maybe get creative and bypass some of those challenges. So it's really interesting when you stack these things in order, how it really works. And it's,
I want to ask Spencer, and I think we should do this for the benefit of our audience. What is the typical process? And let's do debt and equity. Is it different? What's the normal vanilla process? You have a project, you have your strategy, you're ready to go. How do you actually, what's the typical way you just go and raise capital?
Yeah, so it kind of depends on the size of the deal. First off, capital can be raised in one of 2 fashions. Either it's raised on an individual investment. So in a development deal, you get it entitled. You then go out and line up LP equity and construction debt to build the project, right? So, but that's capital just for that one investment. I think that's the most common, the least efficient, but probably the most common.
How, in a minute or less, or as long as you want, how would you typically do that? Like, what's the vanilla?
I'll go into that. So the second piece of that, Joe, though, is programmatic capital, right? So you have a strategy, and so you go to capital and say, this is the strategy I'm going to execute in this fashion. I need equity or I need debt, and they put that up. But the first piece is the more common, which is just raising capital for an investment. So if it's an institutional deal, what will often happen is for the equity, the GP will go to, say, a JLL or a CBRE, their capital markets team, and their capital markets team will go out and raise the equity for that deal. Now, that assumes that the GP has a track record and the GP has some relationships, and it makes it much easier on the capital markets group to go raise the equity. And the debt's generally raised the same way. May even be raised by the same group that raised the equity, also raises the debt. And that becomes now streamlined, right? So you're an institutional group, you're looking to do speed, and so it's worth paying for a professional in a capital markets group to raise that. Now, if you're not an institutional group, or maybe you're looking to save some money, or for whatever reason, using a capital markets broker is not the way to go, maybe you syndicate the equity. Syndicate meaning you go out and you raise it through a whole variety of people. If you're newer, you're likely going to raise it more through friends and family. The more you have a track record, the more that you can raise it through individuals who don't know you as well, likely accredited investors. That's and that process again is more time consuming and less sure, because you don't know how much you're going to be able to syndicate. But if you have a track record, you're likely you can be able to do it quickly. And then the debt, once you have the equity in place, or maybe parallel to that, you're going to maybe a bank or more of a traditional lender, and they're going to be providing the debt. So it really depends on the deal itself. And was that specific enough, Michael?
That's good. Give people a lay of the land.
Yeah. I have a question, and maybe this is premature in the context of this conversation, but in the last 10 years, between social media and everything else, we've seen this rise of crowdfunding, right? And I'm interested, you guys don't do crowdfunding, obviously. You guys, have big capital partners. But I'm interested in, and this is more of like an opinion thing, as how you see the role of that right now, and then does it have legs in the future, or is it something that's just kind of like it falls in that lower tier of investment opportunities? I'm just curious more so than anything, only because we're talking about these different ways of sourcing capital. I mean, we know of a couple of people that are doing it with crowdfunding. Is that something viable right now?
Michael, why don't you chime in? Because this is, I think you and I have a very different opinion here. I'd love for you to start.
Yeah, I think, yes, I think it's extremely viable. I think you go to crowdfunding, you talk about tokenization, all these opportunities that allow people who traditionally did not have access to real estate, other than through REITs or really REITs and public equities, the ability to get in and get involved. Now, it's something I'm very interested in exploring and think about. Spencer and I have conversations about it, and there's legal ramifications, and it's very complex, and there's risks, there's ways to do it, and it's ever evolving. I wouldn't say I'm anybody that has a true finger on the pulse here, but the way decentralized money and all that's working, it seems to be an incredibly important new potential for real estate investing. I think there's a huge future, and I think it's going to become a lot more common. So I don't know, Spencer, your thoughts?
I think it's wildly inefficient. That's my initial view on it. If I need $100 million for an apartment development,
right,
and I can either go to one big LP I've worked with in the past, or I can go raise it from 100,000 people.
Okay.
No. Let me finish. Yeah. So I think it's in its current form, I think it's wildly inefficient. Platforms that exist out there, and I won't name any, so we don't give credit. I don't want to forget anyone, but there's the platforms are out there, and I think everyone knows them. They've done some work in improving the efficiency, right? Internet and technologies allowed that to be more efficient. The regulatory challenges to crowdfunding are difficult to get over. I will say I have a great interest in tokenizing real estate, in democratizing real estate, and the demand for that is high. Right now, the frictional cost for retail investors to access real estate in a more efficient manner is very high. Yeah. And I'm hopeful that in time it becomes more efficient. The cost comes way down. I mean, we see that in our in our current role right now, it's like it's so inefficient for a retail investor. And I say a retail investor, what I'm talking about is someone who has $5,000 or $25,000 or even $100 to invest in real estate. You can either go to REITs, and really in REITs you're paying a 200 to 300% or 200 to 300 basis point premium. And some of that's in liquidity, but a lot of it's just in how inefficient the market is. Otherwise, there's really no access to it. I mean, I guess you can get in a syndication, but then you're putting $50,000 in with someone you don't know, and it's fully illiquid, and it's not very transparent. My point is, if I'm raising capital and I have a choice between a big LP or a crowd fund, yeah, I'm going with the LP.
Well, 100% agree with that. But for the many people that don't, and first off, yes, I agree today. There are a lot of challenges. It's inefficient. It's hard to get involved. But I do see a tremendous future in that, and that becoming like a viable opportunity. I think, and what I said, like tokenization and all of these things going on, there's just a lot of incredible, bright people that are working on this. And so I really think that there's a promising future in it. So.
Right. So maybe on smaller scale, if you're having a hard time getting your foot in the door with capital, this is a place to start, but at big scale, it's
in 2021 it's an option if you're smaller and you have hard time. But I agree with Michael, by the way. I think he and I generally are on the same page here. There's a huge need and opportunity, and someone needs to figure it out.
This is the Trailblazer getting the arrows in the back that we talked about previously.
Yeah, the pioneer getting the arrows in the back.
That's where we are today. But because this idea transcends real estate, like this idea of democratizing real estate. I mean, democratizing a lot of things. The currencies becoming disconnected with governing entities. Like when you look at like what blockchain's doing and all these things, and how like the decentralized yet verifiable, like you can see a ledger and it's not one guy that you trust at the bank, you know, it's independently verified, it's open source, and I think there's just a wave of this. It's a paradigm shift in how we look at the monetary system that real estate will benefit. I think a lot of other industries will too, and I firmly believe that change is coming.
Yeah, I mean, there's a whole discussion around governance. That's a big challenge, right? The nice thing about a two-party partnership is governance is two parties. Anyway, yes, it needs to happen. But yeah.
Okay. So I got us a little off the beaten path there. So let's get back to capital raising. Where are we at right now? Let's go back to that, and then
So we brought up relationships. We brought up track record. We talked about being creative, which is kind of the third door concept. The next piece that can really get you over the hump, even if your relationships are not quite there, and you don't quite have the track record, is a compelling strategy or a compelling investment. And an example of this, part of what I did when I was at the real estate investment arm of Northwestern Mutual is I sourced or placed equity capital. And this wasn't a particular deal I worked on, but it was one that I saw that was just incredible to me. And I can't give many details, but basically a brand new GP, but with a really compelling investment and strategy, and a very, very sharp individual. And it's hard when you're a first-time GP to raise capital, and let alone from LP capital, but a very compelling strategy, and it's worked out quite well. And it, you know, to the benefit of the LP and the LP's stakeholders. So if you're new, but you've got a great investment thesis, don't give up. Even on the most difficult capital to raise, and those big LPs they're tough to raise from. They generally want someone with a GP with a long track record and deep relationships. But when you get the right strategy or investment, you can get over that hump.
It seems to me like this was kind of what you were saying to Michael. The example you gave was, you know, just some creativity and just what turned out to be a really good opportunity, and that's really kind of what made the deal come together.
I don't.
You were talking. We were talking about bringing the different pieces of property together and how they made a really.
This guy had a track record though, but
I mean, in that situation. Though,
in general, yeah. Oh, becoming creative and just
he made a deal that was maybe from the outside looking at what he had initially wasn't attractive, but then he paired it up, made it a lot more attractive.
Well, I think that's part of it. So here's another example. It's very simple. It's from your and I, Sam, history. Our very first real estate deal.
Okay.
Roosevelt.
Oh yeah.
We had no track record. We had limited relationships.
That was,
but it was such a
20
compelling.
years ago.
It was such a compelling investment.
That's true.
Anyone would have done it.
That's true.
And therefore, we didn't have any trouble getting the capital to close on that deal.
Elaborate.
Yeah, so it was. Yeah, I'll give the specifics on it. It was a single-family home. You know, this was Sam and I's very first deal, and we haven't done a lot of deals together. So, in fact, I think it's one of the few real estate investments that we've done together. And I guess I had a relationship with an attorney who had a client that
they were getting divorced.
No, it was a estate.
Oh, that's right. It was an estate.
It was an estate, right? So you have the family, and they have this old home that the parents had lived in. And anyway, so long story short, this old home. It was in disrepair. Now, we weren't wanting to fix this thing up. But what it turned out, because I was in the land development space, this home had some excess land in the back that when I talked to, and I kind of sensed that this was the case, and we confirmed it with the city, that it actually could be subdivided. And so there was a lot in the back. And so the home itself was probably worth, I mean, these are small numbers back then, 100, I think we paid $95,000 for it, but it was in pretty bad condition, but it was probably worth on the open market, 115, 120. And if you fixed it up, the house itself would have been worth 160. So the house had some opportunity to be fixed up, but the lot in the back was worth 75,000 if you can get the lot split to happen. And it was a very compelling investment. It was kind of being in the right place at the right time. And so what we did is we bought it. We split the lot off in the back, and then we sold the house without doing anything to it. And we sold it to someone else, left a little meat on the bone, and that individual bought it, fixed it up, and flipped it. Added value in that regard. By the way, the family that sold it, they were happy as can be because they had the situation. They didn't want to deal with it. They were out of state, and so they didn't have the ability to separate the. I mean, so it was a win-win for them. But in terms of raising capital, really easy. We had the city that was confirming that the lot split was good, and we were going to have the lot split before the home closed. And so we ran out. We raised equity capital.
Yeah.
And and it was a single family home, so getting a loan on. In fact, I think we had to have a what do you call it?
Sponsor?
A co-borrower.
Co-borrower, yeah. Because
co-signer.
Co-signer, that's the term. Yeah. I mean, we were so young, we had to even have a co-signer on, but that was an easy thing.
I think we were 25.
No, we were younger than that.
24?
Well, that would have been in 2001, 2002.
You're dating
22.
Now. You're dating
22,
now.
yeah.
Long time ago. I mean, at the end of the day, when you have a deal that's good, you're right. I mean, it's attractive to capital. They can kind of, see past some of the deficiencies that you personally might bring to the table.
Yeah. Ultimately, what the capital's looking at is, if I have to remove this inexperienced person, is my money still safe? That's really what they're looking at. And if the investment's compelling, and they go, yeah, okay. In fact, it's almost better if the GP screws up and I have to push him out of the way because I've got this great deal here. And so anyway, yeah, that's the, I guess now fourth point here is if you have a compelling investment, makes raising capital a lot easier.
Cool. Anything to add to that, Michael? I think this has been another fun episode. I think that every time we do one of these, the story of how making deals and doing deals, it just becomes more and more transparent and a lot of fun to follow along. So if you've been listening to this, thanks for listening, and we'll see you on the next episode. If you've been watching, we'll see you next time. Thanks for watching, and we'll see you soon.
Thanks for tuning into this episode of the Adventures in CRE audio series. For show notes and additional resources, head over to www.adventuresincre.com/audio series. Would you like to learn real estate financial modeling in a matter of weeks and do it with zero guesswork? If so, the A.CRE Accelerator is for you. The Accelerator is a step-by-step, case-based program designed to teach you exactly what you need to know and in the order you need to know it, so you can gain both the knowledge and experience to take your career to the next level. To see if the Accelerator is right for you, go to www.adventuresincre.com/accelerator.